Good afternoon, and welcome to the City Club of Portland, Oregon's premier citizens forum. We're delighted you're with us today. I'm Don Williams, President of City Club. Our speaker today is Kenneth Wade. He's the CEO of NeighborWorks America. His topic, housing troubles on the horizon, the national foreclosure crisis, and its impact on homeowners, community, and the economy. For the benefit of our radio and television audiences, please turn off your cell phones and other electronic devices. First, a few announcements. On behalf of the City Club Board of Governors and staff, I wish each of you a safe and happy holiday season. We will not have Friday forums for the next 2 weeks, but we do want you to join us for our first program of the new year on January 4th. And this will be our annual economic forecast, where state economists Tom Potowski and Randy Pozdina, who's an economist, a senior economist from Econ Northwest, will share their state and regional economic projections. This is always a popular program. We remind them that they made projections at the year before and review those, so make your reservations early and get in for the fun. And speaking of reservations, another reason to make your reservations early is on January 18th, the City Club will once again host the Mayor's State of the City Address. And there's one major difference this year, however, that Mayor Potter will deliver his address this year at Jefferson High School. The program will begin at our normal time of 12:15, but because of the move to the Jefferson High Auditorium, it will not be a lunch program. And this will be a ticketed event. However, with assigned seating, purchase your $5 ticket on the City Club website or by calling the City Club office. And in January, City Club will host a 6-part series of community dialogues to explore key questions on education and human development. Now, this series is entitled Children at the Center, and it's intended to generate fresh and innovative thinking about educating and nurturing our youngest citizens. Each of these programs will be held on Tuesday evenings from 5:30 to 8 p.m. They'll start on Tuesday, January 8th, and to register, contact the City Club office. Join me in welcoming our new City Club members. They'll stand, and please wait until all are introduced to welcome them. First, Luli Brown. Luli is a faculty member in the Urban Planning Department at Portland State University. Gordon Keller, who is a retired engineer, and Jack Ahan, Vice President at West Coast Bank. Welcome to City Club. And if you're looking for a holiday gift that continues to give for the entire year, please consider a City Club membership. Many City Club members became civically engaged for the first time when a parent or friend gave them a membership, and I know based on my own experience, it's appreciated. To purchase a membership today, stop at the table at the back of the room, and do we have a deal for you? If you purchase today, the $25 new membership fee will be waived. City Club programs would not be possible without the support and generosity of our sponsors, and we'd like to recognize our new sponsors this quarter. And please join me in thanking Edelman Public Relations and the law firm of McEwen Gisvold LLP. Thank you. And finally, before I introduce the speaker, I'd like to just thank a few people. First, the regulars who come to our almost every Friday forum, and you help to make these programs lively, and you even ask great questions. Next, the City Club contributors to our annual fund, and your support is critical to maintain the quality of our programs and our research reports. And if you've not already donated, please consider making a gift before the end of the year. And finally, our acting director, Wade Fickler, and his staff have done a great job during the transition, and we thank them for their good work. The subprime crisis. The United States has weathered financial problems in the past, but the subprime situation may be a little bit different. Some pundits say it was an accident waiting to happen. One economist stated, "This crisis is a bit different than others. It has built in intensity for years without much visibility or attention. It speaks to structural problems. It speaks to an economy built on the quicksand of debt and delusion. A run-up in housing prices has caused affordable housing problem nationwide. However, the growth of the subprime lending and risky mortgage products has now generated a wave of foreclosures across the nation. Recent forecasts predict that 2.2 million subprime borrowers could lose their homes before the end of 2008. And Portland has been fortunate so far. We have one of the lowest foreclosure rates in the nation, and our growth in population and land use policies have kept home prices relatively stable. And even though Portland residents have escaped so far, the more dramatic effects of the national crisis are on the horizon. How bad is the problem? News accounts include descriptions such as, "It's a breakdown of trust in our modern banking system. Financial innovation by the lenders has become financial toxic waste." Who's to blame? Lenders targeted the vulnerable, such as older citizens and those with low credit ratings. Homeowners were greedy and often looked for multiple refinancings to get what they thought was a better deal. And what can be done? Well, the New York Times describes President Bush's proposal as a bank lobby's dream. They characterize it as too little, too late, and too voluntary. The Democrats want to give bankruptcy judges discretion to rewrite loans. And homeowners want quick and simple responses to a complicated problem. We're fortunate today to have a national expert as our speaker to help educate us on this crisis. Kenneth Wade is Chief Executive Officer of NeighborWorks America. NeighborWorks is a public nonprofit corporation established by Congress in 1978. Mr. Wade oversees the multi-million-dollar grant programs and training activities of the organization. His organization supports more than 235 affordable housing and community development programs across the nation. He previously served as NeighborWorks America's Director of National Programs, Initiatives, and Research. And prior to joining NeighborWorks, he worked for 9 years with Boston's United South End Settlements. And when he was in Boston, this is where Ken became a great fan of the Boston Patriots. And he thinks they're going to go undefeated, by the way. He currently serves on a number of boards, including the Fannie Mae National Housing Advisory Council and the Board of Trustees of the National Housing Conference. Mr. Wade received his undergraduate education at Springfield College and the University of Massachusetts College of Public and Community Services. He and his wife live in Washington, D.C., and this is Ken's first visit to Portland. Please join me in welcoming Ken Wade.
Thank you, Don, for that kind introduction. And it is my first time in Portland, but I've heard a lot about the city. There's no question you guys always rank up there on, one of the best place to live indexes. And I can see why. You've obviously got a world-class public transportation system. You've got great land use policy. You lead the nation in green building. And civic engagement. So you've got a lot of things going for you, and I can see why people want to move here. And we're here this week because we do 4 major training events a year. And this week we have a training institute going on here in Portland, where our main hotel is the Hilton, but we're spread out through a few others throughout the city. And we have 1,700 community development professionals here taking training in a variety of community development subjects. So we're pleased to be able to bring the Training Institute here to Portland. It's been a great venue. I think folks maybe spend a little money here. I don't think that hurts. But everyone I've talked to, they've had a great time here, and you all, the city's represented you all well. I also want to acknowledge our flagship organization here in Portland. As Don said, we have about 235 organizations nationwide that are part of our network, and here in Portland, we're fortunate to have the Portland Housing Center. And I know there are a number of staff people here from that organization, but in particular, I'd like to acknowledge Melvin Broadus, who's the board president from the Portland Housing Center, and Peg Malloy, who's the executive director. And you should be proud of that organization, because among their many accomplishments, Peg serves as the chair of our National Advisory Council. The organization is the leading homeownership producer in our network. And in addition to that, we rate all of our organizations based on their performance, and they have an exemplary rating. So you should be proud of the work of the Portland Housing Center. As Don said, NeighborWorks organization is a public nonprofit corporation created by Congress in 1978. And we were created to provide opportunities for people to live in affordable homes, improve their lives, and strengthen their communities. We receive an annual appropriation from Congress, but we're not a department or an agency of the federal government. We're kind of a quasi-public entity. We are a nonprofit corporation, but having been created by Congress. And our board consists of a small 6-member board that is comprised of a senior representative from Housing and Urban Development. The Federal Housing Administration Commissioner serves on our board, as does representatives from the Office of Thrift Supervision, the Office of the Comptroller of the Currency, the National Credit Union Administration, the Federal Reserve Board, and the FDIC. To achieve our mission, we work with this network of community-based organizations all over the country. They're independent organizations with their own boards of directors. They manage their own affairs. And we work closely with them, and we provide financial assistance, technical assistance, and training in order to help them, support their local activities. One of the hallmarks of our approach is obviously working with our local organizations, helping to understand national trends and issues, and helping them develop local solutions based on the local needs in order to address those. We have 4 NeighborWorks organizations in Oregon, the Portland Housing Center being the flagship organization here in Portland, but we also have Neighbor Impact in Redmond, Umpqua CDC in Roseburg, Willamette Neighborhood Housing Services in Corvallis. So in 2007, we've provided $1.3 million in financial support to those 4 organizations in order to help support their local activities. Now, helping families achieve the dream of homeownership has been central to our work for years. And we've been very successful in that effort. Over the good past number of years, we've assisted through our network organizations over 150 low and moderate income families achieve the dream of homeownership. And we've also counseled more than 700,000 families in the home buying process. All 4 of the organizations here in Oregon are key participants in that national effort. All 4 are certified as full cycle lending organizations as part of our network. They provide not only the pre- and post-purchase counseling that help make homeownership successful, they also provide property inspections, affordable mortgage products, early intervention delinquency counsel, and additional services to help low and moderate income families, such as financial literacy, individual development accounts, and down payment assistance. Now, one of the things that we hope is not something that we take away from this current mortgage crisis is that you can't serve low and moderate income people and help them achieve homeownership. I think of the work of the groups here in Oregon that are part of our network, and the work of many organizations like ours around the country have demonstrated you can help low and moderate income people achieve the dream of homeownership. You can do that in a responsible way, and you can do it so that we can create sustainable homeownership opportunities. In our own network, we monitor performance of the consumers to get help through our network. And right now, our loans, or the loans that are with the families that we've helped, perform 10 times better than subprime loans, 4 times better than HUD and FHA and VA loans, and on par with prime loans. So I think that's clearly an indication that if you do this right, you can create sustainable homeownership opportunities. Now, we know that efforts to create sustainable homeownership are key, but unfortunately, too many homeowners recently did not have the benefit of high-quality pre-purchase counseling, that neutral guidance that they would have needed in order to make the right choices when it comes to selecting a home, selecting the right mortgage product for them. We've discovered that far too many homeowners made wrong choices when it came to purchasing a home. And this has led, obviously, to this unprecedented problem that we have with foreclosures. The foreclosure crisis is front page news just about everywhere in America. It's a top priority of legislators and Wall Street because the magnitude of this crisis threatens not only the stability of our own economy, but international financial markets as well. It's estimated that approximately $71 billion in housing wealth will be directly destroyed by foreclosures between now and 2009. More than $32 billion in housing wealth will be indirectly destroyed because of the spillover effect of foreclosures, which reduces the value of neighboring properties. State and local governments will lose more than $917 million in property tax revenue as a result of the destruction of housing wealth caused by this subprime meltdown. And clearly the ripple effects from this crisis are substantial. And kind of to put it in context, some would say that if unabated, the foreclosure crisis that we're facing today would result in the largest loss of wealth for African Americans and Latinos in this country's history, as they're disproportionately represented in subprime loans, and the largest loss of home wealth since the Great Depression. So that is something serious, and we all need to be concerned about it. Now, no one wins really when there's a foreclosure. Obviously, the individual family suffers a traumatic loss of their home, their credit's destroyed for years. Their neighbors suffer because their properties decline in value as a result of foreclosures in and around them. The community suffers. A city can lose up to $20,000 in lost property taxes and other costs related to an abandoned foreclosed property. In Cuyahoga County in Ohio, which is considered the eye of the storm of foreclosures, the county treasurer there has already received 14,000 requests from homeowners to have their property taxes reevaluated and lowered as a result of the downward spiral of home values. Now, there is a common misperception that lenders win in a foreclosure. And at the end of the day, you know, if a bank wanted to get into real estate, there are many more direct ways that they can do that without loaning someone money and hoping they don't pay it back and ended up with the house. Each foreclosure, it's estimated, costs a lender about $50,000. So obviously there's no financial benefit to the lender. The prevalence of vacant bank-owned properties can also disrupt community stability. Around the country, many of these bank-owned properties, particularly in central city neighborhoods, are being looted with everything from copper plumbing to aluminum siding. Oftentimes these homes end up being magnets for crime, squatters and drug activity in and around the properties. So it can have a very destabilizing effect, again, as I said, not only on the family, but the surrounding community. Now, the impact on a small city's budget can be pretty significant when you think about it. With the increased costs from everything from policing to property maintenance. One of our communities in Ohio, again, the annual budget just for the lawn maintenance for abandoned homes is now running annually about $75,000 a year. I mean, and that's a pretty significant hit on a small city's budget, coupled with, the reality that property taxes or property tax revenue is declining. Now, the news on the foreclosure crisis is bad, and it keeps getting worse. Just last week, the Mortgage Bankers Association released the latest results of the National Delinquency Survey. The delinquency rate on residential properties stood at 5.59% of all loans outstanding in the third quarter of 2007. The delinquency rate now doesn't even take into account all those loans that are in foreclosure. The total delinquency rate is currently the highest in the Mortgage Bankers Association survey since 1986. The rate of foreclosure starts and the percentage of loans in the process of foreclosure is at its highest level ever. We know that the crisis is not affecting all states equally. Certain states are being harder hit than others. Right now, 8 states account for 50% of all past due loans. Those states are California, Texas, Florida, Michigan, Georgia, Ohio, New York, and Illinois. In places like Michigan and Ohio, the problem continues to be related to obviously the decline in unemployment related to population loss and unemployment in those states, compounded by the subprime loans that have been made in those markets. In states like California and Florida, many of the problems are attributed to the excess supply due to the speculative overbuilding in those states, again, fueled in large part by subprime loans that were made to people who probably couldn't afford homes that they bought. Now, here in Oregon, you've been somewhat buffeted from this storm. Home prices are relatively stable. Job growth has outpaced national averages until just recently, and the demand for housing remains strong because of the influx of new residents who want to come to one of those best place to live cities. But all of these factors help to undergird, why your housing market has been doing quite well. And from 2001 to 2006, Oregon's foreclosure rate was actually falling. Now, the total delinquency rate was nearly 2.5% as compared to the national foreclosure rate during that same period of 5.1%. But foreclosures here are starting to tick upward. And the data suggests that there is reason to be concerned about the future. A key issue is the impact of subprime lending here in the state of Oregon. According to a study by the Congressional Joint Economic Committee, there are more than 88,000 subprime mortgages in Oregon. These loans are over 11 times more likely to go into foreclosure than prime loans. Subprime loans make up about 11% of the state's mortgages, but they account for 55% of all the foreclosures that you have in the state now. And in 2005 and 2006, the percentage of subprime loans in 9 of your counties exceeded 20%. So with foreclosures concentrated in select counties, it represents a real danger for community stability. Another concern is that more than 9% of all mortgage loans in Oregon allowed negative amortization, ranking Oregon 5th in the nation for those loans. And those loans quickly turn homeowners upside down because basically a negative amortization loan will end up, in most cases, with the homeowner owning more than the original mortgage amount. The slowdown in the Oregon housing market, combined with other factors such as a weakened economy, rising consumer debt, unemployment, spell potential trouble ahead. The Center for Responsible Lending estimates that more than 8,500 Oregon families with subprime loans will ultimately lose their homes to foreclosures if we don't get ahead of this. With the Portland area predicted to be the 34th in foreclosures, among 378 metropolitan areas if the current trend continues. These foreclosures will drag down housing values of neighboring homes and have obviously a destabilizing effect on what you've achieved here in Portland. So it's not that Oregon has avoided the foreclosure crisis altogether, it's just you're a little late to the party. So let me just tell you what we can do to help mitigate this crisis and get ahead of it. Now, last week, the President announced a plan that will help some borrowers avoid foreclosures. And through the efforts of the Hope Now Alliance, which was convened by the Treasury Secretary and the Secretary of HUD, and includes major market participants, and we're part of that alliance, outlined a plan that's estimated to help about 1.2 homeowners by refinancing their existing loans into new private mortgages that are much more stable and better, by moving them into the FHA program, or by freezing their current interest rates for 5 years, buying enough time for those consumers to either improve their credit, for housing values to stabilize so they can get into a better loan. And while this program is not a panacea, it's one step toward trying to get ahead of the problem, because the theory for trying to come up with a program like this suggested that the scale and scope of the foreclosure problem we're facing was so great that we could not continue to work with every homeowner on a one-off basis. And we had to come up with some kind of programmatic approach in order to deal with a significant enough subset of consumers to be able to then put more time and energy toward the more difficult cases. So the President noted that this is not a bailout. Certainly there's been a lot of talk about whether any assistance should be provided to struggling homeowners. I think CNN had a poll the other day. It ran, I think, something like 51 to 49% or something like that, with a slight majority of people saying that they thought homeowners who were in trouble should get help, and a good number of folks saying they shouldn't. And people are concerned that we might be rewarding people for bad choices that they made. Many people did get caught up in the housing market, and for whatever reason, maybe it was greed, short-sightedness, or whatever, they got in over their head, and when the market turned, they found themselves in trouble. Some of those people who are in trouble are indeed investors, people who speculated in the market, bought multiple properties, probably watched Flip That House on cable and thought they could make a bundle, and tried to make a quick profit in the context of this housing market. And obviously that's unfortunate, and I don't think any of these programs are designed to help those people. But there were many families who were victims of a mortgage origination process that was stacked against them. And if you think about the mortgage origination process, and for those of us that are a little older, you remember the old days where the person that originated your mortgage held your mortgage and serviced your mortgage. That's not the way it is today. Typically, the originator gets paid for the origination, they get a fee, they're gone. That loan is sold to some bank who eventually sells it to Wall Street. And that loan is in securities that ends up getting traded all over the world. The servicing is traded almost on a monthly basis. You get a new statement saying your loan is now being serviced by somebody else. So it's a very disaggregated market today that causes a lot of challenges for a consumer. Notwithstanding the fact that it's very difficult to really shop for a mortgage when you think about it. You go to a broker or a lender, you get that good faith estimate, and right at the bottom it tells you, well, it's not really your deal, but it might be. And when you go to closing, that's when you really know the deal you have. And it's very hard to comparison shop. So the way the market works is really, stacked against the consumer in many cases. So home buyers deserve some of the blame, there's no question about it. It's clear that some people just simply didn't understand the terms of the loan that they were getting. These families are struggling to identify ways to prepare for the significant interest rate reset, which would increase their monthly payments. We know that there are multiple underlying factors that undermine a family's finances that can lead to foreclosure. So in addition to the challenges that we all face on a day-to-day basis, you overlay other normal life events like job loss, medical emergencies, divorce. All of those contribute and drive our foreclosure rate. So our experience indicates that community-based efforts tailored to local circumstances are absolutely necessary to help families in financial distress. NeighborWorks and its national network are providing these local solutions, and we need the support and participation of local government, the business community, and others in order to make headway. Now, through the NeighborWorks Center for Foreclosure Solutions, we've decided to address this in a number of ways: raising awareness, building counseling capacity, conducting research, developing early alert systems, and fostering public and private partnerships in foreclosure hotspots. In fact, our Center for Foreclosure Solutions was established 4 years ago because we saw this problem coming. These efforts build on the successful effort that we've done on the homeownership promotion side, using community-based agencies as the centerpiece of that effort, providing counseling and education to homeowners who are in trouble. We also have a national public education campaign that we've done or developed in conjunction with the Ad Council, which is designed to encourage homeowners in financial distress to reach out for assistance before it's too late. The ad conveys the message that nothing is worse than doing nothing. And we created the public education campaign because research indicated that more than half of homeowners every year who go to foreclosure never have any contact with their lender. In addition to that, a significant additional number of homeowners who end up going to foreclosure reach out so late in the process and that they're so far behind that there are very few ways that you can help them. So we think that the public service campaign is critical to get consumers to reach out sooner rather than later. And it instructs homeowners to call a toll-free hotline, 888-995-HOPE. That's 888-995-HOPE, to receive housing counseling assistance that can help them avoid foreclosure. It is the same number that the President announced last week. The HOPE hotline is managed by a national partner of ours called the Housing Preservation Foundation, and they provide immediate access to anyone who calls that number with a HUD-certified counselor, and they're available 24/7. They're available with counselors who are obviously available to assist in English and in Spanish. And for those homeowners who need face-to-face assistance, they're referred to local NeighborWorks organizations and other community-based organizations like the organizations in our network here in Oregon. Now, the public service campaign includes print ads, radio, television. It can also be co-branded locally to direct homeowners to resources in their community. The co-branding also helps validate the messages of the national campaign through the connection of a locally based organization. The Portland Housing Center here in Portland has co-branded the ads here locally. I don't know if any of you have seen them on TV or heard them on the radio, but we are obviously actively working to get more circulation with those ads. We're also building local counseling capacity to make sure there's enough trained professionals to meet the demand. We offer a wide range of courses, beginning with intermediate foreclosure prevention to innovation solutions to combat mortgage defaults. In fact, we're here in Portland, as I said earlier, with more than 1,700 community development professionals. 200 of them here are taking those such courses to address the foreclosure problem. So we're working with groups across the country in order to build local coalitions, and generally the efforts in order to stem foreclosures fall into 7 broad categories. Encouraging borrowers to reach out for help. Our National Hope Hotline is one of the ways that you can help consumers with that by popularizing that number, but also many other local communities have developed their own hotlines, and so that's a great way to respond. We also need to expand counseling availability so that it's available for more borrowers. That's something that local government can do in order to contribute to ensuring that there are adequate resources to make sure we have counselors on the ground to work with consumers. We're working with lenders and servicers to maximize the alternatives to foreclosure, and we've made some significant headway to get lenders to do more in order to keep people in their homes. We're making available, we need to make available options for homeowners to refinance and restructure their loans. There's some very innovative things that are being done by state housing finance agencies all over the country, coming up with new products in order to refinance consumers, as well as local financial institutions stepping up to the plate. You need to take a look at the state's foreclosure process. Many of the processes in place have been around for years and not taken a fresh look to take advantage or to take into account the current mortgage market. We need to strengthen protection for consumers. Clearly, several states have stepped up to create some regulatory changes for brokers and originators, licensing, education requirements, and the like. And we also have to step up the enforcement. Increasingly, consumers who are defrauded have nowhere to turn, and there's a growing problem with things that are called rescue scams, where people are preying on consumers who are in various stages of foreclosure. And lastly, we need to help communities recover from the impact of the crisis. Communities hardest hit will need assistance to bounce back. Policymakers need to start thinking about ways that they can contribute resources and expertise so communities can deal with vacant and abandoned property where there will be an increased inventory there, strategies so that we can turn these into positive assets in the community. So in conclusion, being behind the curve of the crisis here in Oregon gives you a chance to put things in place before it's too late. Intervention strategies will be especially critical in the counties where subprime lending is concentrated. You can learn from the experience of other states to craft an effective plan. I know that 4 of the NeighborWorks organizations are already on the ground working and eager and are part of the solution. And as our tagline says for our public education campaign, nothing is worse than doing nothing. Thank you.
Thank you, Ken. Now to our question and answer period. Asking questions is a privilege of City Club members. Please limit your questions to 30 seconds or less and end it with a question mark rather than an exclamation point. Today's first question will be asked by our board host, Julie Young. Julie is second vice president of City Club. She's a social worker with clinical experience in community mental health services. She co-chaired the City Club's Early Childhood Care and Education Research Committee, and she also sits on the board of Morrison Child and Family Services. She joined the City Club in 2001. Julie.
Thank you, Mr. Wade, for your comments. My question to you is a little bit different than just looking at the subprime issue for particularly lower or middle income homeowners. A recent AP story noted that home ownership, the rate of home ownership has risen pretty steadily in the U.S. It's now about 70%, but the equity that homeowners have in their houses has slipped, has continued to go down, and will probably approach 50% this year. In 2004 alone, homeowners drained over $468 billion out of their homes through home equity loans or cash out refinancing. Some 27% of this money went to pay off credit card debt. I'm curious to know if your member organizations are addressing this part of problem for low-income homeowners.
Thank you. Yeah, that's a very good question. I think there's no question about it. One of the contributing factors is our overconsumption as a country, and We've kind of used our home equity almost as a piggy bank to live beyond our means, and that's across the board, low and moderate income folks and upper income folks as well. And so I think clearly with the financial literacy work that we do and the pre- and post-purchase counseling that we provide to the consumers we work with, that's a key part of what we work with. We get their budget, we work with them, we basically help them develop a plan to reduce their indebtedness, because if we're going to put them on the path to sustainable home ownership, we have to work with them to help them get a handle on their overconsumption. So it is a major part of how we work.
Ray Polani, a City Club member. I was worried because I thought I might be the only one here, but I see that somebody rose to the occasion too. I want to preface by saying that though retired for 25 years, I spent 20 plus years in loan servicing for a local savings and loan, a mutual savings and loan association. So I think I have a little bit of experience in that. It seems to me that we Americans have at least two connected problems. Number one, expecting one automobile per person. Number two, expecting a single-family detached home with 2 or more garages. That doesn't seem to be affordable housing anymore. My question is, do you agree that we have these two problems? And what do you recommend besides all your recommendations, which are very, very appropriate? Is there something specific that we can suggest for our fellow citizens to lower their expectations and think of affordable housing or something different than just a single-family home with garages and automobiles and whatnot? The rest of the world is doing very well with less than that.
Right. No, I think that's a very good question. I think there was a study done some number of years ago with kids from every income range, and they asked them, draw your dream house. And that dream house is very deeply ingrained in the American psyche. It's that nice little house with the white picket fence. I mean, that's what we've grown up to believe is the American, part of the American dream. Now, I know that all of the many community-based organizations do develop other forms of home ownership to make home ownership more accessible, whether that be condominiums, attached townhomes, and the like, in order to help address the affordability issue so that people don't have to stretch so much and do things maybe with loan products in order to get into homes that might be beyond their means. So clearly, expectations is something that we have to come to grips with, and at least at some stage of our life, everyone may not be able to afford that little house on the prairie.
Andy Robeson, club member. Most complex subject, and you did such a good job that even I was able to understand it. Thank you. You talked about 150,000 families that your organization has helped get home ownership. And then you also talked about your record being 11 times better than subprime and even 4 times better than FHA or VA. Could you put numbers to that? How many of your families are suffering through this foreclosure crisis? And could you even put that in terms for Portland? How many are facing that here?
I don't have the numbers here for Portland, and I don't know if any of our individual members in Oregon have that data readily available, but right now the foreclosure rate for the homes that we track from our network is less than 0.1%. So we feel that it's a great testament to how you can do this work with low and moderate income families, do it right, and keep people in homes.
I'm Matt Jaffe, City Club member. I was wondering if you could talk a little bit about the President's plan, what your organization's thoughts on that, and then also state and federal responses to subprime lending and predatory lending.
Sure. Again, the President's plan was really designed to try to come up with a way that you can have a programmatic response to a significant subset of borrowers. So it's going to be targeted at the consumers who are in these 228 and 327 loans. Those are the loans that, you know, had the teaser rate for 2 years and then, you know, kicked into another rate for the remaining 28, and the 327 is just another variation on that theme. Those loans are estimated to be about 1.8 million that will reset over the next year and a half. They represent probably the largest single subset of the subprime loans that people are concerned about. So the notion being, some percentage of those people ought to be able to refinance into a better loan right now. So services will be encouraged to get to those consumers early, offer them refinance opportunities into, in most cases, 30-year fixed rate loans with good interest rates so that they will be sustainable. There will be some people in that bucket whose credit quality will not allow them to refinance into an existing market product. Those people will be offered the opportunity to keep their loan at the starter rate. And the starter rate in most cases for subprime loans was above market for prime loans. So most of these starter rates were 6 plus, 7, 8, and 9 in many cases. So the plan is to freeze their rate at the introductory rate for 5 years. That would buy enough time for the market to settle down, for people to improve their credit quality, and allow them eventually to refinance into something better. In addition to that, there will still be the need to work with all of those other consumers who don't fall into that category, because that also will only be available to consumers who are no more than 30 days late and have had no more than 60 days past due in the past 12 months at the time that they're offered the opportunity. So there will be a lot of consumers who will fall out of that and not be able to qualify, and those consumers will have to be addressed on a one-by-one, case-by-case basis by groups just like the groups here in Oregon who are working with consumers right now.
Fred Mathis, and early in the century, we began to have a slowdown in our economy, and our fearless leader urged people to go out and buy. Now, this has turned out to be very bad advice. Is there any way that the people that proffered this kind of information to the public can be held accountable for that very bad advice they were giving?
Well, I'm really not here to give political advice. That's a little bit out of my league, but I mean, I don't think there's any question that we as a society right now have bought into a level of consumption that's not sustainable. So I think we have to come to grips with that. There's a lot of work being done around financial literacy. We need to start earlier with kids. I heard a statistic recently that the average indebtedness of a kid coming out of college today, excluding student loans, is like $5,000 on average. So kids are starting out their career, you know, behind the curve, you know, from Jump Street. We've got to do some things to turn that around, or else we're not going to be able to sustain the way that we, I guess, think we ought to live.
Ted Kay, City Club member. It appears there's a lot of blame being assigned for this current crisis. Homeowners who were greedy or uninformed, banks, predatory, Wall Street, looking for the fast buck, government regulation not in place. Certainly, many groups will blame many other groups. My question has to do with the cost of this. Clearly, you've identified important and significant costs to this mortgage crisis situation. And I would guess that costs ought to be assigned along with blame. How do you expect that those costs will be allocated in our marketplace?
No, that's a good question. I think the program that was announced by the Hope Now Alliance and that the President announced the other day assumes that the largest burden of cost for that effort would be borne by the investors. Essentially, they will be giving up cash flow because they bought into a mortgage-backed security that assumed a certain cash flow with a starter rate and increasing cash flow as the rate increased. Essentially, when you freeze the rate for some number of time, they will have to forego a cash flow. So in that respect, I think folks feel that since Wall Street created the liquidity to fuel that crisis, that's a significant place that ought to bear some of the cost for this. There are local things that are being done by local government to contribute their share. I mean, every state is doing something to respond to this. And there may be on the federal level, if anything, some money that might be appropriated to support more on-the-ground counseling to work with consumers. But I think everyone feels that, by and large, this isn't something that the taxpayer ought to bear the burden for. I think most of the way that we are approaching this crisis is that the market participants who benefited from the upside should bear the cost for the downside, including, in many cases, the consumers, because they will be giving up some things as well.
Hello, my name is Christine Nutters. I have a question, how you think that the crisis will affect the renters market nationally?
The renters market, is that what you said? That's a good question. I think there are a number of things that are playing out and how it's impacting the rental market. In many cases, it's creating more competition for rental units and driving up the cost of rents in some communities. It's creating more challenging situations for many renters because in markets where you have duplexes and triples where you have maybe a homeowner and rental units, oftentimes those renters have to leave and end up on the rental market as well. Overall, in balance, we think it's going to also have an impact on the rental market where it will push prices up. Now, that's kind of a short-term phenomenon. There is some hope that with the increasing inventory of vacant or REO property, if we can get those in the hands of community groups, they will be able to create opportunities, both rental and homeownership, to kind of ease some of the crisis resulted from people losing their homes. But in the short term, we're seeing it pushing up rental prices in a lot of places.
Corey Allen, City Club member. I'm also a financial planner and a wealth advisor, and I'm curious if you could share what you see as the successful elements of your counseling and educational programs.
Sure. And our curriculum is available. It's online, but it's also available from our great folks here in at the Portland Housing Center. It's essentially designed to look at each consumer's individual financial situation, help them develop a financial plan based on the goals that they have. In the case of homeownership, obviously, help them move toward homeownership. It's clearly designed to help consumers manage within the resources that they have. I know in many cases we encourage consumers to eliminate some of their installment debt, close credit cards down in order to create the kinds of resources necessary to help them achieve their dreams. So it's clearly an individual tailored effort based on each consumer's program, but a heavy dose of that is getting people to understand financial reality, live within their means, and then it also has other components where it helps people understand the home buying process, about mortgages and all of that, and the responsibilities of home ownership. Because as we all know, you make that transition from renter to homeowner, and that furnace goes, there's no landlord to call. You have to have the resources to deal with that. And that's one of the important things that I know our groups stress when they work with homeowners.
Ann Collins, City Club member. Thank you so much for coming to see us. So today, your speech was very interesting. My question is, what is being done to ensure that today's students have financial literacy once they graduate from our schools and colleges?
No, that's a good question. I know we are involved with many others in efforts to increase financial literacy. The FDIC, Federal Deposit Insurance Corporation, has a Money Smart curriculum that's readily available for anyone to use. It's online, it's in English and Spanish, and I think in a few other languages as well. It's designed to work with consumers to help them with basic financial literacy. I know there are increasing efforts to take financial literacy to the colleges, encourage colleges to adopt a robust financial literacy program as part of their curriculum, not be a one-time workshop at freshman orientation, which is the way it is in most places today. And so I think there's a lot of work to be done, including taking it down to the high school level. And while I know there's been a lot of focus on the 3 R's in the high school curriculum, and we've gone away from some of the electives that may have been around in the old days, so to speak, to help people understand financial literacy. I think we need to do more to make sure that kids at a very early age, because when you think about it today, and I know for some of you, I know you can relate to this. When I was a college student, it was unheard of that college students would have credit cards on their own. I mean, if they had a credit card that belonged to their parents, that'd be one thing. But the notion that a credit card company would give a college student a credit card, that didn't exist. Today, I mean, kids will tell you, they get credit card offers every day. So obviously, we've got to prepare our kids for a radically different environment than when we faced, because to a certain extent, I couldn't get in debt, even if I wanted to. But today, that's not the case. So I think we've got a lot of work to do in that arena. All right.
Ken, thank you for sharing your insight with us. We appreciate you also letting us know about the good work that your organization does. We hope you come and visit us again next time you're in Portland. We're adjourned.